Hi everyone. Did you know you don't need 20% down to buy a home? In fact, some programs offer up to 100% financing, and we're going to cover what those programs are on this episode of Opening Doors. I'm Mortgage Pro John, and remember to comment with your questions below, and as always, like, follow, share, and subscribe. Jumping right into it, there are many mortgage programs available to you, the buyer, based on your goals and qualifications. You want to be as transparent with your lender as possible so they can match you with your best options. When qualifying for a mortgage, there are three main criteria a lender will look at. First will be your credit. Each program has a minimum credit score requirement. Next is your income. Your lender will calculate your monthly income whether you are W-2, 1099, or self-employed. Once calculated, they'll be able to determine your debt-to-income ratio. Debt-to-income, commonly referred to as DTI, is your monthly income versus your total monthly liabilities, including your projected mortgage payment. Each program has a maximum allowable DTI. Last box to check off is your assets. Your lender will need to know how much money you have saved up in a bank account to contribute towards your down payment and closing costs. Now, I'm going to briefly go through the different mortgage programs and their requirements based on the three main components we just covered. It's important to keep in mind as we go through these programs that just because you may check each box off, it does not mean it's the best program to match your needs. Let's start with conventional loans. Conventional loans traditionally are most superior and provide lower cost long term. Most conventional loans have a minimum down payment requirement of 3 to 5%, which is much lower than the standard 20% down requirement of the past. The minimum credit score requirement is usually between 640 and 660, and in some cases as low as 620. And the maximum debt to income limit can be as high as 49%. Next most popular program available is FHA, which stands for Federal Housing Administration. This is a government-backed mortgage program that has slightly looser requirements than your standard conventional mortgage. A few things to note about FHA mortgages. This is for primary residences only, and you can only have one FHA mortgage at a time in most cases. Also, you do not have to be a first-time homebuyer to qualify for this program. So let's go over the requirements now. The minimum credit score for most lenders is between 580 and 620. There are some lenders that will do what's called a manual underwrite down to a 500 credit score, but we'll cover manual underwrites in another episode. The down payment requirement on FHA is 3.5%. I should add that when we're talking about down payment, we're referring to the minimum investment you as the buyer must make based on the purchase price or appraised value, whichever is lower. The maximum debt to income ratio for FHA can be as high as 57%. Next, we have one of my favorite programs, which is the VA loan for veterans. This is also another government-backed program, and to qualify for a VA loan, you must have a certificate of eligibility, which is issued through the Veterans Affairs portal. This program allows for up to 100% financing, which is the same as 0% down payment. VA is like FHA when it comes to credit score requirements. Most lenders have a minimum requirement between 580 and 620, but may also lend down to a 500 credit score in some cases. VA is unique when it comes to debt to income requirements. If we were to put a number down for max DTI, most lenders stay in the 40s. Some will go as high as 55%. But because VA actually looks at residual income, which is the money left over from your monthly income after all bills are paid, I've seen approvals for borrowers with over 60% DTI. Keep in mind, these borrowers had very strong income and credit. Which brings me to my next point. It's important to know that the information we covered today is based on the three main components that get looked at when qualifying for a mortgage. But even if you check all these boxes, it does not guarantee your approval for a mortgage. There are still many other factors considered, as well as an automated underwriting system that has the final say. What I will say is if you're at the lower end of any of these qualifications, but two of the three are strong, this helps. For instance, let's say your credit is towards the lower end, but your debt to income ratio is low and down payment is more than the minimum required, then this will strengthen your chances for approval. One last thing to mention. You may check all the boxes for all these programs. So which one is best for you? This is where your loan officer's experience will help guide and match you to the best program. These three mortgage programs are the most popular, but there are other programs out there that your lender may offer to best fit your needs. I hope this information helped motivate you if you thought you may not qualify for a mortgage. That's all from me this episode. Remember to comment below with any questions and like, follow, share, and subscribe. Thank you for tuning in to another episode of Opening Doors. I'm Mortgage Pro John, where buying a home is more than just a dream.